I'm Sean Aylmer, and this is a Fear and Greed extended interview. All the other good bits we couldn't fit into the daily podcast. If you're looking for the daily episode of Fear and Greed, check the podcast playlist. Otherwise, enjoy the interview. I wanted to talk today about inflation, and in particular, why it's something that investors should be wary of. Inflation was the scourge of the late 1970s and 1980s, but aggressive and consistent monetary policy put the inflation genie back in its bottle. In recent weeks, as a result of loose monetary and fiscal policy to address the economic fallout from the coronavirus pandemic, long-term bond yields have started rising, and that suggests inflation might just be something we need to think about again. Jonathan Armitage, Chief Investment Officer at MLC, is my guest this morning to discuss bond markets and inflation. Jonathan is responsible for MLC's multi-asset portfolios for both retail and institutional clients. Jonathan, welcome back to Fear and Greed.
Thank you very much for having me back.
First, let's cover the basics. Take my listeners through the main factors that contribute to inflation.
Well, I think you're right in pointing out that this is something that people are starting to pay a lot more attention to. And really, inflation is the sort of focus on rising costs that feed through to all of us, whether or not it's costs of food, groceries, household items. And for businesses, it can be the cost of inputs into manufacturing, the cost of raw materials, and also the cost of labour. So it's a very important thing to focus on if those prices start rising faster than people had expected.
So why are people talking about inflation again? I thought we'd sort of killed it.
Well, I think you're right. And it's almost as if the word inflation had been removed from the financial dictionary for quite a long time. And you're right in terms of pointing out that central banks over the last sort of really 30 years have done a very good job, strong job of removing inflationary pressures from within the system. I think there are a couple of drivers as to why inflation's sort of back on people's radar screens. The first point is that with the sort of onset of the pandemic and the virus, that actually we're facing the potential for deflation, so prices actually sort of going down. And with very significant action both by central banks and governments stimulating the economy, I think that there's been sort of quite a strong switch from where we were, say, 12 months ago to now thinking, well, there's a lot of stimulus in the system. Secondly, we've now got several vaccines out in the marketplace, and you're starting to see vaccine programs roll out pretty significantly in a number of developed economies, and we're starting to see the rollout here in Australia. And so markets are now sort of starting to look forward and looking to an outlook where economic activity is returning to perhaps more normal levels. And within that, sort of thinking, well, perhaps it's possible that prices may start to accelerate in a greater degree than they have historically.
But you mean we're not talking about 1980s inflation, we're talking about price rises like 2, 3, 4%, that type of thing, as opposed to the 10 and beyond?
Yes, I think so. I certainly don't think we're going to go back to the levels that we saw in the 1980s. But I think it's important that the reason why this is worth thinking about is because inflation has been so incredibly low for such a long period of time, actually relatively small increases in the general scheme of things do actually sort of suggest a much sort of larger change, certainly for markets. And I think it's because expectations about inflation have been so low that actually starting to sort of think about price rises feeding through into the economy is getting investors a lot more attention. And although the numbers may seem very small, actually the impact on markets is much more magnified.
Okay, you mentioned expectations there. Inflationary expectations, economists love talking about it. Why do we care so much about expectations, what people think is going to happen?
Markets are very much sort of forward-looking mechanisms, sort of very much focused on discounting the cash flows from businesses and bonds in the future back to where we are today. And so I think that if you think that markets sort of generally look 6 to 9 months ahead of where things are today, what you've seen is that with the emergence of a number of vaccines, the impact of stimulus packages into the economy, investors are starting to look ahead to perhaps a sort of brighter economic picture, but are starting to think about with its really massive amounts of stimulus that's come into the global economy, particularly in the United States and Europe, as to whether or not actually is it possible that prices may start rising at a much faster rate than we've probably seen for quite some time.
I suppose the point of this argument, which is worth pointing out, is that the Fed chair, Jerome Powell, last week said that the Fed would continue with this loose fiscal policy and maintaining an accommodative fiscal policy stance. That means supporting the economy. Certainly the Reserve Bank has said it doesn't expect to lift the official cash rate for 3 years. So what you're saying is it's almost like a more optimistic view of the economy, which will push price rises through. But how does that gel with what the regulators, at least in the US and Australia, are saying?
It's a really important point. And I think that certainly central bankers around the world seem to be sort of very much erring towards the view that we would much rather see growth pick up and see a sustained recovery in economic activity. And that, if we do see inflation pick up, perhaps we're not as worried as we might have been historically about that, but the focus is making sure that economies don't turn back to sort of very challenging periods that we saw last year. I think what you're seeing markets sort of saying is, right, well, we hear what central bankers are saying, but we're also sort of looking further ahead, and we're starting to sort of see the possibility that prices may accelerate in a way that participants hadn't really thought about for quite some time. So it comes back to this expectation issue. But at the moment, central bankers are saying they are more comfortable with prices rising at a faster rate because it would indicate that economies are recovering.
Jonathan, stay with me. We'll be back in a minute. My guest this morning is Jonathan Armitage, Chief Investment Officer at MLC. Inflation is actually a good thing. I mean, deflation's a bad thing, but why is inflation a good thing so long as there's not too much of it?
I think in some ways it helps sort of asset prices, commodities, also parts of the housing market as sort of beneficiaries of rising or moderately rising inflationary pressures. I think the challenge comes is that if you start sort of seeing prices accelerate at a sort of faster rate. And I think one of the areas that needs to be sort of focused on is that inflationary pressures can move at different rates in different parts of the economy. And so whilst headline rates here in Australia have been very benign for a number of years, we do know that certain parts of the economy have seen rates rising at a faster speed than the headlines may suggest. So, for example, sort of areas like healthcare.
Insurance premiums, I've just paid mine.
Yeah, that would be another area. I think we can all probably look at some of the bills that we pay on a monthly or annual basis and think that prices have certainly gone up more than the sort of 2.5% that we've seen from headline inflation rates.
Yeah. Can we tie this back to the bond market? And bond market, unless you're involved in fixed income markets, which are bond markets, it's a difficult place to get your head around. And what we're seeing here, and we're trying to do a 101 here, is that longer term bond yields are rising. And certainly last week they surged in the US and Australia and New Zealand. Can you explain what the linkage is?
Yes. Ultimately, it's a sort of a future view of what the cost of borrowing could be. I think that that's the best way to encapsulate it. So rising bond yields, the potential to impact the cost that we pay for borrowings, whether or not it's for a house, through a mortgage, for our businesses, owning a car, all those sorts of components will feed off what is happening with government bond rates, whether or not it's here in Australia or in the US or elsewhere. So that's why this is something that some of the terminology when people talk about bond markets is a little bit arcane and quite technical. Ultimately, the importance is because it could impact the future cost of what we pay to borrow money.
Okay, when they're talking about bond markets selling off, the idea is it's fixed income, therefore you get a fixed coupon rate on that. And the problem is if you think inflation is going to happen in 12 months or 2 years or 3 years, and you're holding a 10-year security, that fixed rate isn't going to change. So the price drops because the value is less because it's a fixed rate. Is that right?
That's correct. Perhaps another way of looking at it is that as rates start to rise, the future purchasing power of the dollar that you have today starts changing. And that's why it's important for investors to sort of keep an eye on it.
We'll be back with more in a moment. I'm talking to MLC's Chief Investment Officer, Jonathan Armitage. So with bond yields, we're talking about 10-year rates at sort of between 1.5% and 2%. How does that compare historically?
Well, if we sort of go back sort of 12 months or so, they're sort of quite elevated from when the pandemic first hit. If you go back over sort of much longer periods, sort of 20, 30 years, bond rates are still incredibly low. But I think that the reason why that this is getting a bit of attention is because you've actually had quite a sharp move in a relatively short space of time. And I'll just give you one example. If you look at the yield on the US 10-year Treasury, which is seen as the sort of benchmark, it was below 1% at the end of last year. And right now it's yielding 1.4%. So that's really quite a dramatic change. And I think that that's, whilst they're incredibly low numbers, that move from under 1% to 1.4% in the first 2 months of this year is quite dramatic move.
Yeah, I mean, if you had an equity that jumped 40% in 2 months, we'd be talking about it.
Yes, absolutely.
So what's all this mean in terms of investing, where to invest, asset allocation, that type of thing?
So I think that there are sort of a couple of things that we've been sort of focused on. And a lot of it sort of revolves around inflation will pick up to sort of very material levels. But what are the parts of financial markets which will benefit from rising inflationary expectations? So one of the areas that in our investment portfolios we've been looking at is emerging market equities. They tend to sort of benefit from rising inflationary expectations globally. It suggests that economic growth is sort of picking up, and emerging markets are very sensitive to that. We have been increasing our exposure to inflation-linked bonds in our portfolios. The reason for that is that those are bonds which, saying earlier, the sort of coupon or the return that you get as an investor is actually linked to what is happening with inflationary prices. The other thing that we have been avoiding is actually some of those government bonds in major markets. First of all, because the yields we felt were incredibly low and weren't actually providing you with a return relative to the risk that we thought might occur if inflationary expectations started picking up. So those are sort of some of the things that we've been looking at. One of the other areas to focus on is commodity prices. If inflationary expectations are building up because people think that economic activity is going to be increasing going forward, commodity prices are likely to be a beneficiary of those factors as well.
It's a very complex area, and I mean, we're not a financial advice show, so in no way am I giving anyone financial advice, and the same from this interview, but it does suggest people need expert advice if they're going to get involved in investing their money in equities or in fixed income or in emerging markets or, inflation-linked bonds. Would you agree that people should see a planner?
Absolutely. I think that this, certainly in terms of some of the things that we're sort of talking about and some potential changes in markets going down the track, it's very important to get some professional advice to help in terms of how to think about that. And each individual's circumstances will lead to perhaps a sort of different way of approaching the way that inflation may impact those portfolios. So sitting down with someone who can help give that right advice and help navigate through some changing market conditions, I think will be critical.
Jonathan, thanks for talking to Fear and Greed.
Thank you very much.
That was Jonathan Armitage, Chief Investment Officer at MLC.